Hey. No mai, haere mai, piku mai, kaka mai, kia ora tātou, ko Jason Roberts, whaka inga. Hey, Executive Director aho, AT FinTech New Zealand. Tēnā koutou, tēnā koutou, tēnā tātou katoa. Welcome everyone to this partner event today. This is shared between FinTech New Zealand, Blockchain Association, and kindly sponsored by IBM New Zealand, a long-time NZ Tech supporter. Thank you. Super pleased to be holding this event with, I guess, well, at the moment, around about 200 guests. So there's clearly a lot of interest in this session. Our topic today is titled The Token-Driven Revolution, Understanding the Foundations of Decentralized Finance. We're privileged to have the guest supporter from IBM, Shahid Saeed, and the guest speaker, Nitin Gao, who I believe is calling from late afternoon in Cyprus. And just as we were talking before, Nitin mentioned that he's got 143 countries stamped in his passport. So quite interested to hear your global perspective today. A few a few housekeeping notes. This is an informed event, so we keep it pretty tight and short at 45 minutes. It's set up as a webinar meeting, so if you've got questions, please use the Q&A box or the section that you can see on your screen. We monitor that, and the team will answer those questions as we go through. And finally, the session is recorded, so we'll send out a link later on if you're unable to watch the whole session, or definitely watch that if you get a chance. In terms of the running order, I'll do a quick introduction to the topic today. We'll then hear from Nitin on the IBM insights and understanding of the issues. And also, in particular, the impact of decentralized finance on the financial services industry. So it's clearly a global perspective and really interested to hear about that. We'll follow up with a Q&A session, so do fire up the box, add in any questions as they come to mind, and we'll respond to those either in the session or, as I mentioned before, the follow-up email, the webinar link, and or some questions that we can answer in the follow-up communications. After this event, Shahid has offered IBM to do some follow-up and support, which I'll let him talk about later on. Okay, so let me just introduce the topic. So this session will dive deeper into the constructs that govern the crypto economic models and the token economy. The emergence of asset tokenization has led to massive disintermediation and is rapidly changing the business models of many industries. With finance as an exemplar, we will explore how decentralized finance, or DeFi as it's called, is challenging every aspect of the value movement. DeFi favors network effects, with true innovation created by uniquely combining various applications of DeFi certainly becoming a trending topic in the blockchain community. In contrast to the decentralization of money through Bitcoin and stablecoins, DeFi aims to provide a broader approach to generally decentralizing the traditional finance industry. The core proposition of DeFi is to open up traditional financial services to everyone and providing a permissionless financial service ecosystem which is based on blockchain infrastructure. DeFi is often referred to as the Lego blocks of financial services. It is therefore vital to understand and craft an investment understanding, one that resonates with not only the co-development of the financial innovation and instruments, but also the technology infrastructure that supports these innovative structures and models. I hope out of our session today, there will be a few core questions we'd all like to dwell into, and I'll come back to those in a moment. Let me just briefly introduce you to Shahid, who's with us today in Auckland. For those of you who haven't met Shahid in the Blockchain Association, or indeed through his work with IBM, he's the financial services leader for IBM Consulting in New Zealand, and has been engaged in many innovative banking and insurance projects in India, China, Singapore, and Asia Pac. He's an executive member of Blockchain Association and has a real passion for open ecosystems and data governance. Thanks for supporting the session today, Shahid. And then I'd like to move on to Nitin, who I see is just having a coffee over there in Cyprus, keeping you awake at this late time of night. Nitin is the director of the IBM Financial Services and Digital Assets, with a number of roles he's held within IBM over the last 22 years. You have a very impressive resume on LinkedIn, Nitin.
Thank you.
He's a forward-thinking, business-minded executive with a rich experience as a leader. He's a strategist, an innovator, and is entrenched in the design and development of enterprise infrastructures and applications. And this includes leading-edge middleware and mobility solutions for Fortune 500 companies across 20 countries. Nitin's renowned for his ability to analyze opportunities, anticipate trends, and create technologies that align with operational needs, catapult profitability, and dramatically improve the end customer experience. He's the director of IBM Blockchain Labs. He's responsible for instituting the body of knowledge and organizational understanding around blockchain, technology, and industry-specific applications. Awesome. Hey, look, there's three things we can explore out of today. So how does DeFi impact on a small country like New Zealand? Noting this is a global trend and something that's really happening around the world. For the callers and the viewers today, what can we really think about and focus on in New Zealand? How will it impact our customers? And perhaps what can we do to really address customer demands and the expectations that we might expect? So it'd be really good to focus on that out of our session today. And then finally, who to talk to, how to find out more, and to get more engaged. So I hope that sort of helps set up the scene today for the session. And we'll hand over to you, Nitin, and welcome. Nice to have you here.
Thank you, Jason, and thank you, FinTech New Zealand, for this opportunity to present. And I'm actually in the last minute travel to Cyprus, and it's been a great experience, both in terms of a global perspective and things that are happening around the world. So I have a good 20+ minutes, and I would like to actually compress a lot of my learnings over the years. This is almost compressed learning of 10 years that I would like to communicate to the teams. And let me get quickly with it, and eventually I will explain in terms of how I see New Zealand playing a dominant role in this space, how I see New Zealand benefiting from this space. It's truly a global phenomenon like internet, and it's important for us to understand the space, at least as this evolves. Few things first. The perspective that I present in this deck comes from a lot of failures as well as a lot of successes that comes after the failures, because we learn things, what not to do. We looked into delivering a lot of POCs and projects, but also looked into some of the successful projects that have been delivered in the ecosystem. So I will start with some basics just to level set the agenda, and we'll start getting this little bit of complex. Of course, I have 20 minutes, so the objective is to inspire, not to educate, but I'm always happy to connect and get offline, and happy to share a lot of collateral material that will help make this journey a bit more easier for folks who are just getting into the space. So let's start with, when we look into token-driven revolution, let's understand some of the foundation of decentralized finance. Of course, decentralized finance is one area of blockchain ecosystem. We begin to see NFTs, gamify, which is a term we use for play to earn, Axie Infinity, and Yoka brands, and some of the other ecosystems that are evolving. So this whole space is changing rapidly. And so I'd like to start with what is basics, looking into tokenization and asset tokenization, which has been at least my focus in the past, I would say about 6+ years, is looking into what is a token? How does the token that we deal in blockchain crypto space different from the tokens that we have been dealing with, I would say, from the past 50 or 100+ years, where a typical paper ticket or a amusement park tokens were also a form factor of those tokens, and how that has evolved over time into what you use in Apple Pay. It's payment tokenization, and now what we begin to see in blockchain world is something of value, or token that encapsulates value, whether the value is coming from the incentive economic system of the network, or the value that's embedded by a induced value injection, what we have seen with stable coins and what we have seen with some of the other asset classes. So the whole objective is, in this case, is to understand the emergence of tokenization and how it sort of is the next evolutionary element of digitization, which is what, from financial services perspective, and many of us who are in the fintech space have seen, is the industry has been trying to reinvent itself, both from payment tokenization perspective and also the newer models coming were a byproduct of digitization of the entire industry. And what we see with tokenization is rejuvenation of that entire focus, but also creating very disruptive business models. And that should be the myopic element of what we're going to discuss today, but also a much larger space that's emerging because of this fundamental technology that's changing lives as we know it. So in many cases, tokenization is old. You look at the element of you buying a paper ticket or you buying a token that goes to amusement park, which obfuscates or reduces complexity in you paying at every single ride. You sort of buy a bunch of tokens at one place, you have one transaction, and then eventually you fractionalize those transactions by using those tokens in rides that you like and figuring out as to how many tokens you have and utilizing those tokens in the rides that make sense for you. It gives you more joy and pleasure. We have seen tokenization in the modern world where when you log on, you have sort of a token in form of a SAML token or identity token that gives you representation as you go through various applications and various sort of models behind in application world. The token represents you and provides you access and so on, so on and so forth. So tokenization is not new. What tokenization does for us is it hides enormous amount of complexity. It makes things easier in terms of ease of storage and handling valuables, which is where we're getting with in the blockchain space. And it is, as you will see, the foundation of new business models, whether it's fractionalizing tokens or whether it's creating new business markets or creating new liquidity structures, as well as creating truly global markets, is where we are heading with sort of asset tokenization elements. So the term tokenization is used in a very broad sense, but I think the objective of this is to understand what gives token its value, which is, in my opinion, the biggest challenge in the industry, because you have so much going on, both in terms of what you may hear in the news in terms of crazy valuation of some of the NFTs, 69 million for Beeple. And I oftentimes wonder as to what gives that particular ownership of that digital asset or tokenized asset its intrinsic value. And I spent some time going down the path, and this is, again, some of the models I'll show is a research work of about 4+ years that has gone into sort of splicing the industry, similar to what we have done in the internet era. So a few of the benefits that we see. One is that it's truly a phenomenal element where, while the industry has been, at least the financial services industry, and we will focus on financial services because this is a fintech agenda, has been focused on digitization. In this case, the element of tokenization gives us a few avenues of advantages. One is that when you look into tokenization, then the notion of replicating or copying and pasting it shouldn't happen, which means the token itself should represent asset. It should be, it should allow ease of transfer, which is moving a token, let's say from me to Jason, should be a transactional element, which is what the early days of Bitcoin, which is again 30th anniversary yesterday, has enabled. But then many projects that came after have morphed that basic thinking into introducing things like smart contracts, introducing business logic, and other elements that facilitate that commerce and business that happens on the existing internet-driven digital networks. And then you eventually want to lower cost. I mean, one of the elements of blockchain is a disintermediation. A lot of intermediaries that are involved in truly global movement of assets is something that we're really going after. And blockchain is one of the fundamental tenets of blockchain is to disintermediate many of the parties. So like we have seen with internet disintermediating some of the information brokers, we'll see what blockchain as disintermediating some of the value brokers. Case in point is if you truly have a truly crypto liquid assets like Ether and Bitcoin, then no matter where you're in the world, the rules of engagement are exactly the same. You don't have to go through 6 or 7 intermediaries to, let's say, invest into a derivative or a stock. You could essentially go and have access to the same decentralized financing assets, which today are 12,000 plus different asset classes in that ecosystem. And you have access to all of them if you have truly crypto assets. So you're sort of flattening the entire financial ecosystem by recreating the market structure, but also recreating new instrument classes, which is, to me, just the fascinating space that we're in. Second thing is you're trying to create some of the automation built into it, which is the rules of engagement, what we call as business process management in today's vernacular. You sort of flatten that into a blockchain network, and what blockchain essentially then provides is a transactional framework, allowing you to be able to move assets and with non-repudiation, with certain sense of a certainty and transaction finality. And that's why I think after 13 years, it's an amazing social experiment. I think that Bitcoin, Ethereum, and some of the crypto networks are truly an amazing invention, because those are the networks that you could be from anywhere in the world, regardless of your religious and political beliefs. There is no dispute in terms of who owns what kind of assets. And I think that's essentially what we're going after, is some of the fundamental tenets of trade, trust, ownership that's embedded into a truly global network, creating an egalitarian platform for all of us to be able to transact on, but also embedding some of the elements of trust that's today taken by banks and financial institutions, and there's a cost structure to it. Second thing is fractional ownership. What tokenization does really well is give you the ability to be able to take a token that represents an asset class, like for example, Bitcoin, which is $60,000+ today, gives you the ability to spend $1. If you want to spend $1 in Bitcoin, you can go and buy Bitcoin for $1. You don't need to have the entire $60,000. And so I think that facilitates two things. It creates a more affordable global market, but also induces an enormous amount of liquidity in that ecosystem, which I think is completely either absent, or the structure is not there to be able to facilitate that in the traditional financial ecosystems. And then you have other obvious benefits of tokenization. And I think these 7 or 8 benefits that we have discussed here, though the chart says 7, you'll find that has a long-lasting impact on what we are building as a financial ecosystem. And we'll see how this stacks up against what we have seen with the internet ecosystem around it. So a few things, right, in terms of what is tokenization, and this comes up a lot, where it's really a process of converting an asset or rights and rights or claims to an asset into digital representation. So in many cases, we do talk about the fact that asset never leaves the blockchain. It's the claim to the asset, which is in the form of private keys or some of the constructs as crypto primitives, which makes this entire ecosystem possible. I think it's an important distinction, because as you look into custody and as you look into other financial products that rely upon a counterparty safeguarding your digital assets or your financial assets, in blockchain world, no one is safeguarding your asset, but people are safeguarding the claim to your asset, even though you may have sort of a digital counterparty that is keeping your claim safe, which is keeping your private keys essentially, which is claim to an asset safe. That distinction will lead to a lot of clarity as we progress further. But what's the business? I mean, one business that we see is understanding the exchange vehicle, understanding the valuation model, what gives token its value. Some tokens are a byproduct of the mining, which is the system that keeps the network secure. And that mining capability essentially leads to mining or minting, or in the now staking, which is the newer protocols that are emerging to keep the network safe, to provide the right incentive structures. And that valuation model leads to the fundamental elements of layer 1 protocols. And on top of that, you have other layer protocols that emerge that may be sort of me tokenizing my car. And when I tokenize my car, the sum total of all the tokens that are in the system should not be more than the market value of the car. So the question then becomes that, can I truly tokenize those, or can I truly tokenize my house? And instead of mortgaging it, can I use those tokens to be able to raise either funds or borrow money from the market and collateralize my home if my home is in tokenized form? So that's the disruptive elements of the business model that we talk about with asset tokenization, is giving the ability and removing and solving for inefficiencies of time and trust, because you're creating new business model, not only opening up the truly global marketplace, which is allowing participation of, let's say, a farmer in India or farmer in Vietnam and farmer in Uganda and the emerging middle class and the emerging economies, for them to be able to invest in advanced economies and economies that actually have a different sort of metric and different economic models, like Europe, like United States, like New Zealand, for instance, and be able to create truly global economic system. And that's why we compare what internet has done for information, is truly creating an egalitarian model with access to information, is to provide a similar structure for the globe and the world to be able to move value around the globe with the trust built into the ecosystem, without any nefarious activities or without any fraudulent claims, or including the cost structures that involves with a lot of financial intermediaries who are sort of breeding the business based on the fee structure that goes with it. So those are the fundamentals of the space. And I think part 1 was to give you a quick introduction before we move into part 2. where we will talk about the impact and application of decentralized financing, which takes that discussion to the whole new level in terms of where we are heading with this and what are the elements to understand and get your arms around this super complicated and emerging space. So a few motivations, right? Something that you have to know as you deal with the terminology and sort of the vernacular in the space. One is tokenization, is how do you convert rights into an asset? Some tokens are created in layer 1 protocols, and we'll discuss layer 1 in just a few seconds, where layer 1 becomes the foundational layer which tokens gets created by the economic activity of keeping the token secure, people dedicating the computers. But then you also have NFTs and decentralized financing, which becomes a secondary layer of economic activity, where the people are lending and collateralizing and dedicating the tokens in exchange of other tokens for whatever business activities that may be. And that process is called tokenization. The token itself is instrument that possesses some value. Either it's a value that represents the underlying network and the demand of the network token, or it's a value that is denominated by a fiat, which is the existing cash that it may be kept. The term we use that is stablecoin, or in future central bank digital currencies, or maybe you're tokenizing your house and that token represents certain element of value. And then you have the asset, which is basically what is the underlying asset class. In the traditional finance term, we use the word derivatives, which derivatives is a derived asset from the underlying asset. But in this case, the asset then becomes this, whether it's the value of trust that the token confirms the security of the network, or it's dependent upon some physical asset. And that becomes a really interesting challenge where, to me, the most complicated element of the space from a technology design perspective is to create digital token for the physical assets, because suddenly now you have to tie the digital token with physical assets. It's a lot easier to create tokens for digital asset or virtual goods, only because of the fact that these are truly digital goods and you're simply creating a digital representation. But if you're creating a token that represents a physical good or a house or real estate, then you have to make sure that the movement of that goods, which is maybe a car or a container on a shipping yard or avocados, whatever that may be, it has to follow the movement of those goods, which means the digital world cannot be separate from the physical, from the real world. And that requires a lot of intersection with other technologies like IoT and so on and so forth. So I think it's a little complicated to build that digital world, which fractionalizes tokens and create tracking and tracing mechanism, which is what we have seen in supply chain realm. But it's rather relatively easier to be able to create token for virtual goods and digital ecosystems that are emerging. One big advantage that I think is that the existing financial system, as we see it, there's a valuation model, there's a risk model, there is some of the elements of stocks and bonds and equities and your home and your mortgages. Banks understand this, and we call them bankable assets, which means you have a vehicle and avenue to value these assets and claim. So as we claim our own net worth, that's a product of this ability for bank to value your assets. But there's still a lot of assets that we value that are non-bankable assets. These could be your, if you're a pneumatomist, could be your stamp collection. If you're, your currency collection. If you're a philanthropist, could be your stamp collection. And if you end up tokenizing those things, then collectively you can see that the value of non-bankable assets, or your patents, or your paintings that you acquired over time from not so famous painters. Many of these, I think, where we are seeing, which is what projects like Avegochi has done with NFTs, is ability for you to collateralize your NFT and borrow against it. So you can imagine the aperture of borrowing and lending significantly increases. That today, if you look at some of the numbers to give you the gravity of this space, is collectively there are about $471 trillion worth of global assets in the ecosystem, which is all stocks and bonds and mortgages and homes of all the economies that we have on record. These don't include homes that are built, but there's no record for those. But these are the borrowing and lending of collateralized assets. If you include non-bankable asset, the number goes up to $2.54 quadrillion, which is a trillion of trillion dollars. So you realize that you're sort of creating a much larger economic ecosystem, a much larger and more diverse sort of financial system, which is, I think, of interest and value to us. The next two slides is something I think you should take away, even though I think the slides will be available to you, is I looked into internet only because we compared internet with information and blockchain with things of value, and looked into what gave internet its value. And I'm looking at the next generation of the Amazons and Alibaba and Tencents of the world, who have truly, after almost 30 years plus of evolution of internet, 40 years of evolution of internet, have truly sort of leveraged this in terms of collapsing supply chain, collapsing payments, and giving you a singular experience of ordering something online and obfuscating the entire payment ecosystem behind the scenes, making payments to the suppliers, obfuscating the entire supply chain, the complex supply chain that goes. And they have done this by, again, collapsing a lot of layers and extracting the inefficiencies in terms of cost and in terms of intermediaries. When I evaluate that with Bitcoin or blockchain ecosystems, I look at layer one, which is Bitcoin, Ethereum, Solana, Cardano, and there are like a good dozen of those who are trying to give you the foundational layer. And then you have layer two, which is trying to eliminate the inefficiency of layer one, which is providing you the security or providing what Lightning Network has done with Twitter, speeding up payments. And then you have layer three, which is getting into a little bit of more application layers, such as giving you a tokenized framework of creating tokens and providing a supply and demand elements of those tokens, verification services, ability to issue tokens, piggybacking on the underlying token issuance mechanism of layer one, layer two. And then you have layer four. Layer four is where we see decentralized exchanges, we see liquidity pools, we see all these niche elements that we hear about, including some of the art NFTs and art exchanges, even though some of the exchanges are centralized exchanges. But those are layer four protocols, which is sort of obfuscating and the complexity and making that experience such a singular experience for the end user. Take a look at this slide. There's a paper behind this. Connect with me and you'll have access to the paper where I talk about as to how are the similarities, and eventually technology itself is deflationary. Over time, it loses value. So I keep focusing on the higher and higher layers as the industry comes to some certain level of maturity in this space, and look into how each of these layers make money. I mean, how do you commercialize these protocols? And what you see on the left-hand side or right-hand side are the 5 ways of how a token is monetized today, how a token is commercialized today. And each of them have their own little nuanced avenue to be able to create value. But at the end of the day, what you should think about when you look at a token is that a token should have a collective cumulative effect of the underlying layers. So if I'm looking at layer four should have cumulative effect of the layer one, layer two, layer three, which is what should give it value. So as you go up higher level of echelon of this particular stack, you'll begin to see that higher level tokens should have more value because they're all encompassing of underlying values, because they're paying for some of those elements around it. I see a few questions. Give me a few more minutes and I'll answer some of those questions. Applying that sort of a broad level stack to a decentralized financing, which is one of the disciplines and one of the economic systems emerging in blockchain, is exactly that. We look at crypto sort of liquid tokens like Ethereum, Bitcoin, which is layer one protocol. And eventually we go to layer two, which is digital assets, whether you're crypto native assets, byproduct of crypto economic systems, or NFTs or fungible tokens like stable coins. Then eventually you go into collateralized debt positions or decentralized exchanges or synthetics, which is fractionalizing, let's say, Tesla and IBM stocks and Apple stocks, and creating digital securities, which is ability for a small company to raise funds. And a lot of that is happening today. And then you see some of the niche sophisticated services like yield aggregation and liquidity mining and liquidity pooling. These are all stacks, and each of those token, again, is reliant upon the underlying layers. And that's how I would look at this. But what you see on the left-hand side are traditional equity companies who are providing meaning and valuable services for these regulated instruments. So price oracles, which provide price guidance and price points around what asset is worth. KYC AML, which is required by many jurisdictions for most legalized marketplaces and asset exchange mechanisms. The regulatory and compliance elements of reporting, keeping your assets safe on behalf of the end user. So if you have a Coinbase account, or if you have an account with one of the digital asset exchanges, you'll find that those are kept on your behalf. So while you may have an app, it is just a ledger entry. You don't really actually own your tokens yet if you're going through one of the centralized exchanges, because they have to mitigate risk and they're keeping the assets safe for you, and that's the digital asset custody. So many of what you see as adjacent support services in decentralized financing world is sort of a centralized service as we see it. A quick thing, how do you value these assets? And I took the traditional world of, and this is again a real world that my team did. So I'm not taking any credit for it. It's all my team, super smart people. We look into trend, we look into volatility. So trending basically exponential moving averages with as volatile as crypto assets are. We look into what's the math behind how often they move and what's the reason behind it. We look at volatility of it. So if you look at Bollinger Bands, which gives you the min, max, open, close, and we look into what the volatility is, and we look at the momentum of those. We calculate these things to make sense of this industry. Just like you have e-commerce and shopping and petroleum, all these are linked industries. We want to find what's the linkages between these two, and it's a complicated space. And this picture doesn't tell you anything except that we've looked at 100 different tokens, and we find, and what you find as deeper blue colors are tightly correlated assets, which means if Bitcoin goes up, this asset will definitely go up. And then you have non-correlated assets, which means if Ethereum goes up or down, then it has no effect on, let's say, a type of NFT, for example. And so we did the same thing for what investment industry does that with funds. And the funds will let you either follow your conviction, or if you don't know much, you can diversify and put your money in all these different tokens. And this is, by the way, some of the work that I'm doing with some of my cohorts in Australia to build this sort of portfolio and say, what is the linkage between, let's say, NFT and layer one? And so that classification it goes down to this level of detail around it. 2 more slides, and then we quickly jump to Q&A. This is what happened. And the risk of presenting any blockchain slide is, this is 3 months old, but it looks like it's almost a generation old slide. This happened the first 6 months of 2020. And I know, sorry, last 6 months of 2020, and this being almost at the end of 2021. But a lot happened where a lot of known players have made some massive investments, and collection of this is about $40 billion from the traditional players. And I would remiss to say that after 13 years of Bitcoin paper, this industry is about $2.7 trillion today. So the regulated, the traditional finance, the names that you see here, Visa, MasterCard, DBS, PayPal, their investment has been minuscule compared to the overall industry valuation, which to me is a sign that this is truly disruptive in nature, that all the big names, which Bitcoin was a bad word 10 years back, are suddenly jumping on the bandwagon because they find this immense amount of opportunity in that space to bring this to market. 6 areas that me and my team are focused on. I've been focused on this for 6 years because these are still unsolved issues. So if you're an entrepreneur or you're academic or you're getting into trying to figure this out, I think these are still areas of digital identity, digital fiat, asset tokenization, security elements, scaling of blockchain, governance model are still the areas that I think industry needs a lot of focus on. So having said that, Jason, I'm hoping I'm doing well on time, though my time tells me it's time to get you over Q&A.
You're fine.
Yeah, so Joy, tokenization of an asset has all the functionality you describe and potentially offer many societal benefits, but doesn't the model work for more with more integrity if all components of ecosystem are tokenized? Absolutely right, Joy. So the challenge that I have in my world, just to give you a perspective, is we already have a world that we live in, which is a digitized world, which is traditional finance, and we deal with sort of a batch relay of these ledger entries that help us move assets. And there'll be a time when it'll be pretty messy, where we deal with banks, and banks have to deal with, if they happen to be in the business of keeping our tokens safe and keeping our tokens in line and give us a single visibility, which is what PayPal is doing today. The vision is that you can have a wallet, and that wallet you can have a payment instrument, you can have a stable coin, you can have a CBDC, you can have a cryptocurrency, and eventually you can have a tokenized security. So imagine you having a wallet, and the wallet could have a token is a token is a token. And the token could represent a security, which is a stock, a synthetic stock, a fraction of, let's say, an Apple or Tesla. It could have a stable coin, which is a payment instrument. It could have a Ethereum Bitcoin, and you could go buy a coffee with any of those, and the system will hide the complexity behind the scenes, giving you a singular experience. And that's the world we envision for the next generational element. So you're right. Eventually, for this to truly work, the entire ecosystem, the point of sale systems, the token generators have to be token aware. But to me, it's what we call as a quasi decentralized system. That it's a spectrum. Some of them are completely tokenized, some of them are not, and that there's a lot of interim step that we need to do to marry the old with the new. And that's where we are sort of a lot of technical stuff that you see even on this slide, which is behind this, which is element of security design, element of digital identity. Digital identity, exactly that, is tokenizing your identity. Because I cannot assign a digital asset to your driver's license or passport. It simply doesn't make sense. Jason, in terms of asset ownership tokenization like NFTs, how do you deal with issues regarding use value being tied to technology that may become obsolete? Great question, Jason. Actually, it's a really, really good question that keeps the community and people who are leading this. But if you look at advancements that we have seen with both some of the dominant Bitcoin and Ethereum communities, there's a constant evolution. If you look at Ethereum, it's a very chaotic system, a constant technical evolution that's been updated on a regular basis. We see outages every now and then, which should never happen in blockchain, at least in theoretical levels. We see a change in economic system that they're moving from proof of work to proof of stake. The community is the biggest power of whatever we're discussing here, whether it's layer 1, layer 2, and community decide what's right for the community. It's a truly democratized system at that point, and the developer, and there's an incentive economic built into it. So for example, staking is an incentive economic model. The ability for you to create a bounty is an economic incentive model. The ability for you to be able to use the foundation to fund the core developers who are developing the ecosystem and creating proposals for changes is an economic incentive model. I think that's one avenue that most projects are embarking upon to ensure that you have checks and balances, which is what I'm calling as governance model, the very last or the 6 areas. It's really, really important to have an open governance system, which allows for a design that is able to consume newer areas. So whatever we're doing today is, let's say, using a level of cryptography, and in future we may use a higher level of cryptography. What is the avenue to induce that change? And let's say in future we end up using quantum cryptography. How does the platform itself evolve from that perspective? So as we design at a technical level, we look for those things and say, hey, we got to keep this a little bit more open. And that's when you begin to see things like soft forks and hard forks as a consequence of those changes, because they're either incompatible or they have gone through the technical life cycle and they are simply untenable to maintain the level of security that we need to maintain. So hopefully that answers the question. Chris, if blockchain will effectively increases liquidity and ease of liquidity, will it serve to increase cash flows into the public and private equity markets? That's a great question, Chris. So I had built a private equity network for Northern Trust in 2015, 2016, early days. And the objective was exactly that, is ability for me to reduce the cost of the legal cost that's incurred, which is enciphering these contracts into sort of tokens, but also creating secondary markets. So most private equity, as you know, doesn't have a secondary market, and you're locked in for with capital calls and capital commits for almost a decade. But in this case, you have the ability to take those tokens and float them in secondary markets and provide an avenue to be able to buy and sell and generate liquidity. And because these are tokens, you can create smaller fractions to increase the affordability and in secondary markets. So there are enormous amount of opportunities which I think it should increase the cash inflows. But the question then becomes the mania. Because things are affordable doesn't mean they're valued right. So the question then becomes, how do we maintain the balance between the sum total of all the fractions of these tokens should add up to the true valuation of the asset on a whole. And I think that's where the governance model comes into existence. And then you also have demand supply curves, and we have seen that with tulips, we've seen that with the housing markets, and it goes on and on. At the end of the day, the laws of demand supply sort of squash all the other economic imperatives that we decide from this perspective. What's your favorite layer 1 protocol and why? Faye, I have many, and of course Bitcoin should be all of our favorite. That led the revolution we were in. I just like Ethereum. To me, I find Ethereum as interesting, biggest community, enormous amount of innovation, except that I find that Ethereum, it's its own worst enemy. The valuation of Ether is sort of hurting itself, because you don't want to pay that high cost of transaction, which is why we got in this first place. So I see Solana and Cardano meaningfully working to address those areas, but it simply doesn't make sense. Like, while the industry is high on all-time highs of Ether, but Ether is a transaction system. And if Ether is high, then that means that the value and the cost of processing transaction on the network is very high, which defeats the whole purpose of why we're doing this in the first place. So hopefully that answers your question. George, great presentation. I would love to get a recording of slides. So George, I have a smart contract. You need to send a few Bitcoins and the slide gets transferred to you in a Web3 or more mode. And that's typically how we roll. Of course, I'm kidding. You certainly have access to the slides and reach out to me. I'm happy to sort of collaborate. Brian Ventura, it seems IBM's blockchain is agnostic with its digital asset advisory business. That's a good one, Brian. So there's a story behind this, Brian. When we started the journey, we had to build something for the enterprise. And at the early days, enterprise wasn't ready for where the public blockchain network is today. So we look at this as a spectrum where Hyperledger fabrics of the world are sort of quasi-decentralized, but you need an admin, you need a consortium, and the governance models. And if you move from there to completely like a Solana or Ethereum, which is truly decentralized networks, we have, at least after 4 years, me and some of us have said, you know, we need to have a much bigger aperture to understand the industry. You cannot put all your eggs in Hyperledger basket. So we began to venture into other protocols, and I built a payment network on Stellar. We looked into Ethereum, and now I'm looking into Solana, looking into Bitcoin, figuring out the financial crimes in that space, only because you have to follow the wind and all the transactions and all the cool projects and all the majority of the $2.7 trillion worth of economic activities happening on these networks. You simply cannot ignore them because you're trying to sell software, right? And so we have to be cognizant of what we are solving for the closed consortiums and closed industries, and what we are trying to solve for the open industries that are emerging. Faye, what condition do you think we are missing to make tokenization of real estate in Australia and New Zealand? Well, Faye, multiple things. The entity that is involved in dispute resolutions, the registry of your assets and the banking ecosystem is not yet ready for tokenization to lend you. Though I've had conversation with some of the leading banks in the region to what is the apparatus needed to start, because they do already have the lending models. So how do they take your tokens and lend against it if you're in real estate space? And the one way to circumvent that, and that actually is happening in Australia, is what people have done is create something called an SPV, which is special purpose vehicle. It's an entity that you create, and that entity becomes the owner of a house that is registered with the county or a community or municipality. And you take that house, the SPV or special purpose vehicle, eventually fractionalizes those. And so you have access to the SPV. SPV itself has access to the housing. And that's how this is done today. And it's the reason why people are doing that, which means there is still a level of intermediation here, is because of the fact that the entire apparatus is not ready for tokenized. But it's a journey again. The moment county begins to recognize tokens, then you remove the SPV as well. Or the other avenue is SPV becomes a DAO, which is decentralized autonomous organization, like a smart contract, and that could be a software entity on a blockchain network. So hopefully that answers the question. If tokenization is chair I'm sitting on, then sell a third of it by buying a coffee. Who owns the chair? So JV, that's a philosophical debate. I think the question becomes adhering to fundamental elements of trade trust ownership. So the question becomes then, as I said earlier, that tokenizing physical assets and moving physical assets based on the ownership becomes a challenge. So if you simply want to have a claim on the chair, that's fine. But if you're actually moving the chair, which is what we have seen in case of containers that move avocados and apple and perishables from South America, let's say North America, or let's say from Asia to Australia, then those have consequences. Which means that whoever owns the token is culpable and responsible. So if they screw up or they mess up and the fruit goes bad and the perishable goes bad, then they are liable because of the mistake, and that liability of culpability is something that we're trying to induce. So I'll leave the philosophy, since we have short time, we can take this offline and debate this a bit more on that. Hi, Nathan. If you were looking at Polkadot, Cosmos, Cardano, claims would be top of that's a great one. So they all do different things, Bridget. Polkadot and Cosmos were designed for interoperability because of the fact that each blockchain ecosystem is a closed, even the open networks, but they're still closed ecosystems, which means the assets on one cannot simply move and be recognized on a different blockchain network. So Polkadot and Cosmos provide a bridging mechanism that allows you to be able to move assets and that enable things like wrapped Bitcoin wrapped Ether and create sort of intermediary tokens that provide bridging of it. Cardano is a layer 1 protocol. Even the Polkadot and Cosmos claim it to be layer 1, they're layer 1 in their own rights, but they have a different objectives and different element to the meaning. On factors like strength of community, VC interest, momentum. To me, it's interesting evolution that VCs have begin to invest, which was never the intent of this ecosystem, was meant to be truly democratic. But because they're attracting funding, I think it's speeding up innovation and inventions, which I think is always a positive thing. Like every mania, there will be bad stories will come from it, but there'll also be amazing stories that comes out of it. So hopefully that answers the question, Bridget. And if not, then we can take it offline. Tom, what are the downstream impact of tokenization, 2.5 quadrillion assets? Yes, the downstream is 20% of all Bitcoin networks are unclaimed assets. And I'm partly guilty of it because in 2013, 2014, when I was experimenting with these, we didn't know much. They weren't infrastructure like Coinbase, so we had to maintain the keys on our laptops. And I would give my laptop a refresh, and I have lost a lot of money in today's value. I have lost keys on purpose just to see what's happened. I can still track so 20% of Bitcoin is simply floating around unclaimed assets at the moment. That's a problem. But there are a lot of projects who are looking into solving that issue of ability to recover your keys and ability to reclaim the assets and so on and so forth. And that basically, again, deals with inflation and deflation elements in terms of how these things sort of evolve. But remember that it's not, when you have 21 million Bitcoins, these can go up to 8 decimal fractions, and in some cases 12 decimal fractions, depending on the project, which means that it's still not the lowest common denominator or lowest common unit. And that makes a huge difference in overall economic value of where this is heading, of how you define it. Anonymous attendee, have you looked at Terra? I have. It's one of my favorite projects, anonymous attendee. I think well about it, if that's what you want to know. So I'll stop at that because it's the question you asked. What it does and why I like it. I'm happy to expand on that on a separate call. But I like Terra, I like Luna, I like some of the things they're doing with synthetics. If you look at some of the Terra Labs people, what they have done, what Anchor Protocol itself is doing. And so there are a bunch of related things that are happening in that space. Aldano, what is how to develop a blockchain? That's a big question, Aldano. I read a lot. I still spend, if I'm not traveling, 4 to 5 hours a day reading, and I still feel I don't know enough, which means that, you know, it's a sense of humility that you bring. So no matter how much you know, how much you do, all I will say is that none of us know all of it, no matter who claims what. So just be hungry and just learn as much as you can. And I would say there's enough how-tos and enough white papers, but I would go with foundation elements of understanding some of the blockchain architectures. And I missed a few. Joy, if digital tech and tokenization can fundamentally challenge not just banks, but the current financial foundation of a country, do you envisage a time where it extends even deeper into national frameworks? Of course, Joy. Central bank digital currency conversations, the securities and exchange commissions around the world who are looking at security tokens and labeling them with the old lens is exactly manifestation of that challenge of challenging nation states. But I'll tell you this, that these are global phenomena. Bitcoin, Ether, and many of the crypto liquid assets are truly global systems that if you have access to these assets and you have the assets, and I use the word crypto liquid because they're truly liquid in the entire ecosystem, everybody will accept your Bitcoin and Ether and some of Solana and Cardanos of the world, or dots and atoms. And what you probably do is you can exchange them for other asset classes on the blockchain ecosystem from anywhere in the world with same set of rules, same access points. So you have flattened, you know, that entire ecosystem and you know, create an egalitarian access, which today was only confined to many of us who had access to banking and banking through investment banking and ability for you to be able to invest in US securities or ability to invest into, let's say, European securities from New Zealand. That's no longer the case. We've seen that with Axie Infinity movement in Vietnam, where during pandemic, people were using pay to earn and they were able to feed their families because they were able to use these tokens to be able to monetize and create economic value from it. So to your point, I think what you're referring to is exactly what's happening, which is the reason why all the regulators around the world has become so big, they simply cannot ignore anymore. Jason, how am I doing on time? A few more questions? Are we good?
You've got till 11:30 actually, so we can push it out a bit longer. The other option is we can take a record of the questions, and Shahid can follow them up after the session with a recording.
If I have 8 more minutes, then let me go. So I was rushing because I was not aware of time. So what's a credible place to learn how to learn? Okay, I think I answered that. Royden Schotter, legitimacy of hard asset purchase such as real estate requires observation of ownership, which tends to a geographic issue. How do we get around this? That's a great question, Royden. Actually, I've been able to buy in the past some real estate completely online. So the notion of observation of ownership relies upon a process that you prove, and you have a bank and you have bank transfers and you do all these things, and it takes enormous amount of time, and refinancing of course of a house is treated as a new purchase, and you end up still spending 6 to 7% of the value of the house. To get around this, first thing is, if we were to go down the path of tokenizing a real estate property, then the observation piece of this would imply that there's a duality of a transaction, and as you're moving the ownership of that house either to you or to the lien, which is the entity that's lending you tokens or money, that observation would simply imply that you have a what we call multi-party computing or multi-sig, where you and the bank collectively own the asset, and both of you would have to sign to release the lien. And there are two conditions that you could incorporate into a smart contract, which means you either pay off the loan or collateralized lending that you could have, or you both sign in the event of a sale of a deed. That's the world we've envisioned around this. It's a little hard thing to grasp at the moment because of still the crypto primitives that need to be dealt with, which means I don't want to lose the house because I lost a pair of keys. It's the consequences of that blunder, which happens a lot in the space we live in the crypto space, or the ability for, let's say, what we have seen with smart contract hacks and technical risks and protocol risks that we have seen. You don't want to lose a house because somebody was able to find a vulnerability in a smart contract. And I think that the industry is doing a pretty good job of fixing those issues, but I think one way to deal with that is to incorporate multi-party compute, but also multi-sig elements that you always need 2 or 3 people to sign, especially the owner of the house. So even if somebody is able to compromise the underlying transfer mechanism, they have the ability to be able to still give you consent before they do anything in form of signatures. What do you think, Australia for DAOs? The only state I know, Jason, is Wyoming, and it has flaws, I think, in terms of legal recognition of DAOs. I think, and this question came up a lot before as we were preparing for this, for participants here, is what can a small country like New Zealand do? And I would remove the word small. We should look into what role New Zealand can play, because Singapore is small. Philippines is smaller than New Zealand. We can look at, not in terms of land mass, of course, but in terms of, not in terms of population, but in terms of land mass, for example. But the question is, the opportunities are immense, which means that you're not limited because, you have 4 million people on the island, or 4+ million people on the island, and let's say Philippines has 100 million. It's the use cases you're going after. And if a country like Singapore can evolve and establish the prowess in leading with regulatory frameworks and modernizing the financial ecosystem and leading with trade finance and trade logistics and moving and leading the charter for Asia Pacific, then there are 2 elements. Either New Zealand and Australia in the region can play catch up and adhere to what economies like Singapore and like more progressive elements like what Dubai has kicked off recently have to say, or you can stay ahead and say, we're going to pass these regulations, attract not just capital, which is the global agenda. And I'm in Cyprus today, and I was in Dubai 2 weeks back. Even though it's COVID, it's really pain to travel. Some of the objectives that we have seen is every country is utilizing this movement to attract capital, but also attract talent. You get the smartest people in the world because you have the right regulatory framework to develop these projects and not have to deal with the regulatory uncertainty that we have in the United States, for example, as we speak, or in some jurisdictions around the world, giving you the ammunition and arms to be able to create these amazing projects and engage the globe and benefit from that. So bringing high talent, high finance can do a lot of good to any economy, whether it's large or small, right? And so I would have that perspective and not rely upon the fact that, hey, we're a small country, we're only 4 million people. I would just remove that, because you begin to see struggling economies like Vietnam and Philippines doing some amazing job in speeding up the innovation and engaging the community in terms of whether it's gaming or whether it's stable coins, whether it's payments, trying to solve real day problems. And I think you should find New Zealand's niche in terms of what that would be for New Zealand's future, whether it's dealing with some of the Micronesian islands, and you being the powerhouse of that, or you playing a dominant role in Asia Pacific to bring along the Singapore and Indonesian transactions that are happening in that space. Anonymous attendee, if you were a startup wanting to tokenize your shares, would you start? That's a great one, anonymous attendee. I would focus on capital formation. Your capital formation is a completely wide space. So if you're trying to redo our capital markets, the way we buy and sell and exchange stocks, you're going to go through a lot of hurdles because you already have a system and that system will fight you. But if you go, which is what the global digital finance, that some of the work that we have done in the space is tokenizing, ability for you to raise funds. And that space is white space, which means you let entrepreneurs raise money using this platform, and raising money would be construed as digital securities. And you would issue securities as a SAFT or a SAFE, which is simple agreement for future equities or simple agreement for future tokens, as one of the avenues. I would use that because there's less regulatory hurdle. It's not been done. It's not like you have any platform, though there's a lot of attempts happening in the US and in Europe. So that's one area I would tackle, anonymous attendee.
Yeah. Can you hear me okay? We're just a little bit short of time, and I'm aware that there's 3 or 4 more questions coming through. My thinking is that if we hand over to Shahid to follow up on what we can explore in New Zealand and carry through with some of the elements of your conversation, and then also with the questions that we've got, if we could follow them back to you. You're clearly on a roll with awesome content, and there's a lot in there that we can absorb and take more from. So will you be okay if we just get one more question quickly answered, and then we'll hand over to Shahid just to...
Yes, we'll do one more. And again, it was an honor to present to you guys, and hopefully you'll never get back this 45 minutes of your life, but hopefully this is worth your time. So last question from Annie is, we currently have additional inequity and exclusion in Aotearoa, which I assume is one of the communities in the Maori communities, if I'm not mistaken. Right?
It's the name for New Zealand. Okay.
Why do you believe we should consider around digital inequity and exclusion? So, Annie, I come from India, and I can completely address to you with what you're talking about. And I moved to US 30 years back, but I always go back to India to give back and at least understand that space, even though India is doing great from perspective of getting to digital. I think the bigger element than blockchain is digital penetration. We've tried to solve this financial inclusion issue with mobile devices when they came out. It's not solved yet. We have tried to solve the identity issue, which is what India tried with Aadhaar card and stuff. And so just to label blockchain to say blockchain will solve the digital financial inclusion, not entirely true, because we still have to create systems that the less educated or folks who are not familiar with it, people could be highly educated, but they may not be familiar with the technology and cryptography element. So I think we have to focus on 2 areas. One is a massive digital penetration, which means it becomes ubiquitous and people don't have challenges getting on digital platform. And second thing is you create protocols and systems in such a way that people have implicit faith in it, that when they transact with somebody else around the world, the transaction goes through and it actually happens. There's no nefarious activities, there's no fraudulent claims in that ecosystem. Until that happens, we'll still be fighting the financial inclusion issue that you're talking about in digital inequity. So I like the word digital inequity because that's exactly what it is. It's not access to, I think the system is there. We simply have to enable, educate, and empower these communities to be able to do, which comes with regulation, investments in our communities, which is, I think, a good note to end on, I think, if I'm not mistaken, Jason.
Yeah, the whole point around how customers understand ultimately and engage, and how it's supported by regulation and systems that are easy to use, then it will really it'll really get moving and make it accessible, which a few people have commented on before. On behalf of FinTech and Blockchain Association, Leslie, I'd like to say thank you very much. Clearly, you got some great coffee over there to keep you going late at night, and we really appreciate your help and your support and a huge amount of intelligent content. Thank you. Shahid, why don't I just quickly pass over to you, because I know you had a few closing comments, and then we'll finish the session.
Yep, thanks Jason and Nitin for an excellent session, and thanks to the participants. Lots and lots of engaging questions and suggestions I'm seeing on the chat board. So the key point I would like to highlight is, if there are some interesting topics we want to explore, I'm in Auckland and Nitin is a global citizen. So together we can have follow-up, like a couple of hours or a half a day, design thinking led human computer design kind of a session, and thresh out what kind of use cases make sense. So that's what we could do. Do reach out to me and we can make it happen. Thank you. Jason, back to you.
Brilliant. Okay, look, we'll send off an email after this with the link for the recording for folk to watch in their own time. The record of the questions we'll keep, and we can pass those on as well. Look, again, thank you, all of you, for presenting and participating today. And that's both for the speakers and, of course, our wonderful audiences in New Zealand. Have a great day. Talk soon. Take care. Bye-bye.
Bye, guys. Ciao.